Welcome to Stock Talk with NIKO'S. Today we're going to be going through an extremely valuable metric I have created that I call NIKO'S stock market checklist, and it's going to show you all the things to look for when you are picking stocks. Okay, so the way this works is there is a list of 16 different criteria, and if the stock hits at least 12 of these 16, then I consider it a buy. For the most part, maybe there's exceptions out there, but for the most part, this is how it's going to work. So the stock, first, let me take you through the 16 different things. We have the stock is down over 25% for large caps and 35% for mid caps. And then you can see, all the way down, there's all these different things about income, revenue, PE, are they innovative, different metrics, return on capital, profit margins, all this different stuff. Okay. So what we're going to do in this video is I'm going to take you through an example of the stock we're going to use as a stock I've been buying lately called Ollie's Bargain Outlet, ticker OLLI. And we're going to go through and see if it checks off all the points. Now, I have not done this. I've been buying the stock for about over a month now, and I have not put it through this test yet. So we're going to see how this goes. So first one on the list is net income growth over the past 3 years. So if we look at their income, and then the second one is revenue growth over the past 3 years. So if we look at net income and revenue, we can see that really for the past 7 years or 8 years, it's been going up and up and up and up. So everything looks great here. Over the past 3 years, they went from $1 billion to 2020, they did 1.8. Earnings were 127 million, and they went to 242 million. So the company's been growing very nicely. Last year they grew revenue 28% and earnings increased 72%, which is insane, but that was just because of the pandemic. So that's not always going to happen. Next up we have is the stock down 25% if it's a large cap or 35% for mid cap. Ollie's Bargain Outlet trades at a market cap of about $4 billion. So that's considered a mid-cap company. And by the way, I have 22 shares of Ollie's at a price of $64 a share in this account. And then I have another account that has some other shares too. But if we look from its highs earlier this year, it hit $106 a share, and now it's $66 a share. So that is over a 35% drop. So that's going to get a check too. So these all get checks. Next up, we have a healthy return on invested capital and return on equity. That metric we can find right here on stockanalysis.com. And if we go down, we can see that return on capital of 25%, return on equity of 15%. Those are higher than a lot of companies out there. So far we're looking good. To be more specific, a lot of times you're going to want to compare it against a similar company. So that would be like, you could do like a Walmart or something, but I think a better one would even be a Big Lots. Big Lots is pretty much the same thing. It's a discount retailer. And so Ollie's, their business model is based off of, they buy used up inventory or canceled items or whatever from big retailers like Target and Walmart, and then they sell those products for cheap, and they sell it at a high enough margin to where they're making a good profit. So Big Lots return on invested capital is 8%, a lot lower than Ollie's, and then the return on equity is 21%, which is a little bit higher than what Ollie's reported, but still Ollie's has great numbers. So we're going to give that a check. Is this company innovative? No, I would not consider this an innovative company. They're just a retailer. Smart, focused, trustworthy management, and or they're founder led. So this for this company, the CEO is John Swigert or something like that. And this guy has just been the CEO since December of 2019. So hasn't even been 2 years yet. But I did read that he has been with the company for almost 20 years now, just in different positions. And so he has lots of experience, and the management team, as you can see, they've been doing a great job with growing this company and growing revenue and income. So everything looks good there. Now it's not founder led because this company is 40 years old. So the founder is not there anymore, but the management team they has been doing great. So we're going to give them a yes. Healthy profit margins that we can find right here. And keep in mind that this is a company that sells, how I said, discounted items. So it's not like they're going to have huge profit margins. Gross margin of 40%, profit margins of 11%. Now, that's actually more than I would expect because, okay, profit margin of 11%. Let's go back to Big Lots and compare that. So Big Lots profit margin is 4%. So you can see Ollie's is doing great there. Now let's compare it to a Walmart, because Walmart is a little bit different, but they're still, you know, the biggest retailer in the country. Their profit margins is 1.7%. So as you can see, Ollie's has 11% is actually very high for what they're doing for their type of business model. 11% is fantastic. So we're gonna give that a yes. Healthy free cash flow. You can find that right here. And as you can see now, keep in mind this is going to be. They have been trying to. What they've been saying it for years that they're trying to expand the number of stores they have, and they've been doing it. But I think it got put on hold this year just because of the pandemic. So once they get back to increasing the store count, that should help to stock out in a major way. However, the company's still been doing a great job increasing their operating cash flow. As you can see, the past couple of years, it's gone from 95 million to during the year of the pandemic, they did 360 million. And then now the past year, they did 192 million. So still fantastic numbers there. We're going to give that a yes. Is the industry growing? No, it's not, because this is a company that competes with something like an Amazon. So Amazon's probably taken some of their market share, but at the same time, I've read that Ollie's actually has better deals than Amazon. Okay. And so, but as a whole though, is the industry growing? A retail store? Not really. More things are going online. So I'm going to give that a no. Low forward PE. I do believe this one trades at extremely low valuation. And as you can see here, a forward PE of 17 is pretty low. So we're going to give that a yes. More long-term assets and long-term liabilities. If we check out the balance sheet, we can see that we'll go by as of last quarter, as of July 31st of this year, their long-term assets were 1.2 billion and their long-term liabilities was 397 million. So that's a great ratio there. That gets a yes. More current assets than current liabilities, yes, as well. As you can see, it's almost 3x the amount of their current ratio is almost 3x. So that's definitely a yes. This company's in a fantastic financial position. Everything is super healthy. Okay, next metric is, does the company do a share buyback, or do they pay a dividend with a low payout ratio? And so if we go and check here, we can see that over the past year, so this tells us the number of shares outstanding over the past year and the past quarter over quarter. So over the past year, it's dropped 1%, and that's not a huge change, but it's a step in the right direction. And so at least they're not diluting the shareholders. So that's going to get a yes, because they are buying back shares. Next up, are hedge funds, big investors, or insiders buying? And we can find that information right here. So the price target on this stock is $83 based off of Wall Street analysts. Insiders not really doing much. It's pretty much looks like it's been equal for every time they've bought, they've also sold. So nothing too substantial there. Hedge funds, as you can see, over the past really 18 months, the number of hedge funds holding has been increasing. So that's a good sign as well. We're going to give that a check. Increasing equity. This is always a great one to look at too. As you can see, so their equity now is 1.3 billion on the balance sheet. Over the past couple of years, it's gone from 796 million, 942, 1 billion, 1.3 billion. That's fantastic. Once again, they're growing very nicely. diverse customer base, this just means you don't want to have all of your revenue coming from one customer. So the more spread out it is, the better. And the more you just want to have you want it to be diversified. So one thing we can look at here is the review. So based off of where I'm at, the location near me, they have 4.2 stars on Google out of 879 reviews, which is good. If you read through these reviews, everything looks pretty solid, except for some people say the only complaint really is that it's not organized well. So maybe that's something they could improve on. But other than that, I know that they are trying to increase the number of stores they have across the country. And I mean, anybody can go to Ollie's. It's not like they're only getting a small segment of the market shopping there. So we're going to give that a yes as well. So now if we go through and we look through all these things, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 yeses. So this is considered a buy, 14 out of 16. And that's why I bought the stock. So this is what I use to measure stocks. I think this is a great thing to look for when you're valuing a company. So just check this out and let me know what you think.